answering fan questions about the Australian budget bill. Let's get straight into it. Xiao Kiao, mommy asks, if I don't have an investment property, can I turn my current home into one and buy a new home? Can that original house then be negatively geared? Page 157 of the budget bill states that properties under contract before May 12th are grandfathered in, meaning they can still be negatively geared. Currently, there's no distinction based on the property's original purpose, so for now, it seems feasible. And he asks the opposite. If an investment property becomes a primary residence for life, how is CGT calculated for the investment years? You pay CGT normally for the investment years. For the period before July 1st, 2027, you can choose the old rules. After that, use the new rules. Any capital gains from the day you move in are tax-free. But honestly, if you never sell, how would you even pay capital gains tax? Next, Running Bear asks, are primary residences affected? No, they aren't. Next, a viewer from the live stream asks, what does it mean that CGT is at least 30%? Look at page 2 of the ATO details. Simply put, if your marginal income tax rate is already above 30% in the year you sell, it doesn't matter. But if you have no other income that year, you'd usually have the 18,000 tax-free threshold and low tax brackets, right? Not anymore. It starts right at 30%. However, if you receive Centrelink payments that year, you're actually exempt from this 30% minimum limit. So here's a tip. Divorce your husband the year you sell, get the house and kids, get Centrelink as a single mom, and pay less tax on the sale. To be honest, the Labour Party is really out of its mind. Next, Chi Kwang asks, if my property hasn't beaten inflation, should I use the new calculation to get a capital loss? And Ding Ding asks, what if the CGT is negative? What if the house price dropped? There are actually 3 scenarios. First, if your gains beat inflation, you pay tax on the portion above inflation under the new rules. Second, you lose to inflation, but you still beat your original purchase price. For example, a Melbourne townhouse held for 10 years rises to 1.1 million. If inflation means 1 million in the bank would have become 1.15 million, then that 100,000 gain is tax-free. It's not a 50,000 capital loss based on the 1.15 million inflation figure because you didn't have an actual loss on paper. In the third scenario, you not only lose to inflation, but you also lose against your original cost. For example, a $1 million Melbourne apartment sells for only 800,000. You've truly lost 200,000. That's a real loss that can offset future capital gains. Next, I Am Who I Am asks, if I have a property that's permanently negatively geared, can I take money from its offset account to pay for a second older property and keep negatively gearing the first? The answer is no. The ATO defines negative gearing for loans using a purpose test. It looks at the purpose of the investment, meaning whether the thing you're investing the withdrawn money into can be negatively geared. If you invest in an existing property which can't be negatively geared under the new rules, then the interest on that withdrawn money isn't tax deductible. But what you can do is use a rental debt cycle. Check out my previous videos on that. Michelle Shu asks, an existing property bought after budget night can't be negatively geared against salary, but can it be used to offset rental income from other properties? Please explain. Yes, let's explain this first. Michelle's question is, if I have 2 houses, A and B, can the positive cash flow from A offset the negative from B? Both are existing homes bought after the new rules, so theoretically neither is eligible for negative gearing. But can losses from one offset gains from the other? Yes, according to the ATO's budget details. On page 1 of the details, note the